Moment. Okay, everybody, hello and welcome. You are here for the February 2026 jobs report and inflation updates. My name is Albert. I am the founder of Albert's List. We are here to help you become the most resilient professional possible in AI, side hustles, and job search. And as a part of what we do here at Albert's List, we also believe in sharing with you why everything is the way it is, why everything is uncertain or certain when the economy is great, and to really help explain to you the economic underpinnings of everything that may govern how you feel about AI job search and side hustles. And I'm always happy and proud every single month to bring in my friend, Dr. Reilly White, professor of finance, and also the Associate Dean of Teaching and Learning and tenured Pro Professor of Finance at the University of New Mexico's Anderson School of Management. He's the director of a $6 million student-run UNM Regents portfolio, leads a series of financial literacy projects in the community, and was awarded the 2022 Paul Bartlett Reemerging Promoter of Peace Award and the recipient of a 2022 to 2023 New Mexico Changemakers Educational Fellowship. In addition to serving on the Board of Trustees, Dr. Reilly White has also written quite a bit about everything from finance to financial technology, cryptocurrency, and everything in between. If you do a quick Google search, you can look at many of the things that he's written about, both in the media as well as in cited academic journals. So it's an opportunity for us to have somebody who is incredibly intelligent, incredibly qualified to share with us what is going on in today's economic situation. So we hope you have questions. We hope that you have thoughts to share, insights. We do this every single month here on this webinar. And so we will be doing that for the next hour and a half and change or so. Dr. White, thank you so much again for sharing your time with us this month. As always, we hope for you to quell our fears,
Okay.
increase our excitement for the opportunities that are coming by, and look forward to seeing what you have to offer. The floor is yours.
Thank you for the wonderful introduction, Albert. It is a joy. You guys are my favorite audience to speak in front of. I love your fantastic, often Bay Area centered, magnificent questions, which is very appropriate, and I love it. I don't know if I have charisma, but I got charisma. Thanks, Mike. And yeah, this is true. What a time to be alive. Things are happening, and we're going to talk all the way through it. I got some great questions sent to me by Albert about the audience. Thank you guys for being here and spending your time with us. If you're operating a moving vehicle or machinery or all those things, just beware. So one of those things. So today, and I was thinking about this when I was doing an AI generated prompt for this, and I figured out what would a Scrum Master look like in my mind. And I know Scrum Masters, but it's always like a pigeon that's seen better days. And so I think it did a good job at this. Again, I did not have, and people are like, well, didn't you commission an artist to do this for a PowerPoint slide? And I did not. But it is an interesting time. Why the conjoined? Because, Melanie, you can double up on the job market if you've got double the experience. So if you were looking at genetic conjoining yourself with another person, just think of the years of experience that you can have collectively. That's today's job strategy is as chimeraism. So one of those. So let's talk about this jobs report. You got it in the news. Even the news was like, this was terrible. We did expect a positive number, we being the general consensus for economics and finance this month. Oh, unfortunately, it was not that way. We lost 92,000 jobs in February. About one third of that is due to temporary strikes. December revisions showed a loss of around 17,000 jobs. So even the revisions from back in December from 2 months ago actually put the December numbers negative as well. Mike says, literally saw a post today for a job requiring 10 years plus vibe coding experience. That's really good. I think a bird like that will get the job. You're like, I've been unemployed by a bird. The bird has a beautiful place in really in just a really upscale part of the peninsula right now. It's fantastic. You should. Birds are doing very well in this economy. This might be the first action month we've seen where the numbers were negative and not revised downward. Albert's right. This has been a while. Healthcare and social assistance, both down negative. Healthcare hit particularly in the area of strikes and social assistance. But strangely enough, while always disappointing in every capacity, financial serve activities just rocketed up to the top of the ladder with 10,000 jobs across the country this month. That is highly unusual and also very strange given the senses and the stresses on the overall market right now. And the strike at Kaiser, exactly. Albert's right. So we saw the healthcare numbers isn't a draw on the overall trend. This is driven by, as you've expected, the strikes that we've seen. Labor force participation is around 62%. And while the BLS actually shows and says, well, it's very close to being unchanged based on where it was previously, it's actually down about 0.5%. And the employment population ratio were also markedly lower. So for some reason, we had a particularly larger than average, and this was recalibrated after the sort of after the annual revisions. We kind of look at the population data and figure out what our participation rate is. And we are tracking a little bit lower than we should be. And this is an interesting dialogue. So this is really good. Oh yes, network as well. Iqbal, thank you so much for bringing this up. Please contact each other on LinkedIn, etc. This is a great avenue to do this, and a great group of people who are very supportive. My allergies are just off the roof. It's been like everywhere else in the West, incredibly hot out here recently, like unusually warm. So everything is like springing into life so much earlier, and all the leaves on the trees and the flowers and all these things. And so I'm struggling with some allergies, so I apologize. Unemployment rose a little bit, 1%, 1.1% to 4.4. Still very low when we think about big averages. And one of the things I want to kind of contextualize today is we've got there's always bad news in the marketplace. Bad news trades. I know these are all the things that we discuss, that we engage with. Bad news is kind of the way we rock and roll. Time change is making everything bright. The endless New Mexican sun is just burning me to a crisp, and the allergies. It's supposed to be like 85 next week, which is for us, at 7,000 feet in elevation, just absurd. Junipers, Melanie, exactly right. They're everywhere. They're in my face. They're everywhere when I drive. We have one plant, and that's what's blooming. So unemployment rose to 4.4% from 4.3. So I apologize. This reflection will be done in a little bit here. Megan, welcome. Thank you. Welcome from Maryland. Connect with Megan. But the overall unemployment numbers are good when we consider it versus the long-term averages, where we do trend a little bit higher. We're close still to what we call full employment, but there are some reasons to be concerned, but also some reasons for hope. Here are some reasons for concern first. I can't just run into hope without giving you more reasons for concern. So first, one of the things that's been sort of a cornerstone of this administration's directed policy and looking at is trying to build back the American manufacturing workforce. The American manufacturing workforce, having taken years of various hits, it is true that globalization, of course, and specialization has reduced those jobs and those jobs availability. Competition comes from everywhere. There's a whole bunch of reasons why we just can't produce, and the market demand is such that we can't produce a lot of goods here like we used to. And that's for good and for bad at the same time. But a change in manufacturing employment since January 2025, when we talked about sort of the imposition of tariffs, we're down almost 100,000 workers. And we look at the Economic Policy Institute. That is not small change. It's exactly what we all said would happen if you impose tariffs, even if the tariffs are in turn then repealed. This is exactly the kind of thing you see. So if I was trying to protect a market by increasing the price of the input goods, what it does is, for instance, like aluminum, that means every other item that uses things like aluminum actually ends up with higher prices along with it, and they have to lay off workers. And so I'm trying to protect one thing, but I'm damaging everything else to a greater quantity. And it is just consistent in literature. I may protect 10,000 jobs doing this. I will lose 50,000 jobs as an effect of doing this in other sectors. And when you have just widespread tariffs like we've been having, this is having a negative effect on it. But another thing that's happening is, of course, the labor force cuts in the federal employment right now. Looking at federal workers, we are down about 327,000 since January 2025. That's significant beyond most years that we've seen prior. And if you're looking at a couple million federal workers, it is a sizable dent. But not incidentally, where we derive most of our government expenditures, and our continued gap in our what we're spending versus our revenue as a government continues to rise. And so people are being cut, but not unfortunately benefiting much in the bottom line. But here is the other issue of this puzzle. How is the economy doing? What are we looking at? Is the economy, meaning that nameless, faceless, amalgamation of all of us put together, how is that doing? So we look at the gross domestic product, the value of goods and services that we make in the United States. And look at that growth rate. That's on the top chart here. And this is from the Federal Reserve Economic Data source that you can just look up online. Since 2016, we averaged typically around 2%. We've been at a little bit higher clip on average, about 2.5%, almost 3% growth. Oh no, did I lose you guys again? Oh, my internet is so bad. I don't know what to do. So I apologize. I think my computer locked up again. So I apologize. 1 second, I will hop on again through a different way. Join from. Sorry about that. Can you hear me? Okay, my apologies. So sorry. Thank you guys. You back? Are we good? Thank you. Good, good, good. Thank you guys. All right. Sorry about that. This might happen again. I'm trying a few things. I obviously my ancient and hulking along desktop PC is on its last legs. It has two little legs. I gave it figurative legs, and it's been stressed out by when I open more than one browser. So my apologies. And then being New Mexico, when more than two people are on the internet, we just shut down as an entity. So I apologize and thank you so much for your patience. So we'll go back a bit and I'll kind of reiterate where this cuts off, and I'll do my best to kind of. I'm screwing around with some different modes here, so we'll see if we can do it. And I hope it won't crash again. And if it does, Albert will just hop in and do the rest. He's got this. He's 100%. He's been trained in this. Um, whoops. So everyone else is using the party line. So anyway, GDP is actually cruising along at a pretty good rate. So GDP is growing fast. That implies also what we've seen for our productivity ratio. One of my requests was, can you show any good economic data? This chart is full of good economic data. GDP still positive, still growing. Productivity is increasing rapidly. A lot of reasons for that, right? We know we're doing more with less, sometimes fewer workers at times. We're not hiring, but our productivity is going up. It's tricky. So there's been debates as to how to attribute the increase in productivity. Is it that we're now somehow much better at engaging technology because of AI? Is it because we are more efficient in the post-COVID space in our supply chains? There's been a lot of proposals around there, and AI spending, to Albert's point, is fundamentally the leading contender in our interpretation of today's data. AI spending is so great that we're putting so much money in there and so much generating so much economic angst that it's actually driving and moving the needle on this in ways that many other investments aren't. Now, will this pay off or not is a completely other question, but we are positive here, and that's very interesting. Now, when we go down to the employment population ratio, this is the key number to show how well an economy is doing. Are you employing your workers? Do your workers have jobs? Are they gainfully employed? Or do they want to be part of the labor force? And in the 25 to 54 category, the category where people run their careers and their lives and their consumption and their housing and their children and their dogs and their cats and their gerbils, we're up above 80% consistently since 2022. This is about as good as it gets, in other words. So we're still seeing people gainfully employed. We see periodic layoffs in some parts of tech. We see some areas specifically not hiring, but this has become quickly an ossified job market. This is a place where there isn't a lot of fires, but also not a lot of hires. And that does, to our kind of previous point earlier, disproportionately affect people with less experience in the workplace because some of those jobs just aren't there. Now, productivity, output per hour, the number we're talking about. So we are tracking ahead of the curve, kids. We're up 2.2% above the forecast in Q4 2025. This is from the Congressional Budget Office. And if we go back to January 2020, we can see how this productivity changed. Now, productivity, the amount of economic activity an individual worker can do. Notice that it went up sharply in COVID. It went up sharply because we fired a bunch of workers. Having fewer workers perform that same level of economic activity means that productivity goes up. Likewise, though, we hired back and productivity seemed to kind of flatline for a while. Enter 2023, 2024. It's on the rise again. It's increasing, and in fact, increasing faster than we thought it would. It is driving economic growth, investments in AI infrastructure, contributing drastically to this place. But as Albert points out, companies Atlassian just cut 1,600 jobs today, citing AI. Their stock is now down 53% to date. Correlation. Now let's unpack that a second. So Albert, that's a really good question. What companies attribute layoffs to versus why they actually happen? And so I'll give the example. I'll give the parable of like a minimum wage or living wage. So I worked recently on a policy initiative in Santa Fe, where we talked about what a fair living wage would be or minimum wage, and we developed something kind of novel. We developed one that was kind of tied into housing costs, which was the first time a city had done it this way for increases. And you look at the questions and you look at the research in it. I got really in depth into minimum wage research and. Companies typically will say, "Oh, minimum wage went up in the city, and so therefore it's why I had to close. It's why I had to lay off people because I didn't have enough." But it's actually interesting. You dive down in the data, it's actually much more nuanced. Companies that are less productive end up failing. Companies that are successful more productively use their workers in these spaces. And so what's also happening is AI is allowing people right now to more productively use their workforce in a way where we're generating workers and you're saying, okay, we don't need to hire more people for this. Let's just be more productive in this space. It absolutely is happening in different ways. But Atlassian is interesting. Now, the company itself, 1,600 jobs, and is nothing to sneeze at. And they do a whole bunch of stuff, right? So they're okay, collaboration software. Let's see how their stock price looks. Um, I know, and their headquarters are in San Francisco too. So I apologize if this is the first time you're hearing this. I'm sorry. So I'm here to kind of, I'm sorry. The following people on the webinar have been laid off. Mike, no, I'm kidding. No, one of those two. Mike says, I think I posted this last month, but AI layoffs are looking more and more like corporate fiction that's masking a darker reality. So well said and well linked, Mike, and I appreciate you pointing this out. So you can blame it on AI, but there's other things that are happening in the narrative. The AI is easy to villainize. And this is actually this Fortune article that Mike posted is a nice little look into this space because we're not replacing workers with AI, but we're seeing that companies are kind of using it as cover for what would typically be headcount reductions for business productivity issues and other things that deal with their company. So if a company is already not doing badly, raising the minimum wage isn't going to help them. It might drive them over, and AI might drive them over, but it's not something itself that is necessarily to blame in this. And it is a factor, and I don't want to point that out, but it's not always the why. And so sometimes the why gets detached from the reality that we want to create with the news that we're releasing. So Scott says, related to MIT's discussion, MIT's living wage calculator was last updated on February 15th, 2026. Ah, that's excellent. And Albert says, does blaming a layoff in AI as opposed to corporate mismanagement because stock being down 53% is a sign that seems to placate investors? It's very difficult when you cover yourself this way because the stock is down, right? You know that for some reason the stock is down. People are weighing in. Millions of people, when they weigh in on the stock market, are assessing what a company's future profit potential is. A stock price is nothing more than one discounted present value of all the future cash flows, the profits that a firm is going to make brought back to today. That's how stock markets move. So when there's bad news, I'm not just adjusting my expectation of the profits of a company next year. It's 10 years down the line, 15 years down the line, 20 years down the line. And if you're, your finance 101 students know that when you crunch these numbers, most of a stock price's value is based off of long-term growth potential. And so it's already communicating to investors that they weren't competitive in the market the way that they should be. And so it's down 3% today, but block stocks soared 20% when they announced. Very interesting thing. So the point is, can you fool the market on this? And I would say most of the time, no. The market does know better. Atlassian might have gone down because their market's like, oh, you're lying. I'm calling your bluff. But Block may have been driven by something else. I have to get into these companies individually. We should just rock and roll this. Melanie, everybody's needed to pay for Atlassian's chair. That's all right. Oh, Atlassian. What a time. So there are other things at stake. Don't take a look at the company and okay, let's think like a finance professional. Let's think like an analyst. Think like how I teach like my investment students about how to work like this. And finance is a tricky subject. You have to know everything about everything when you pitch a company and you get up in front of an audience of people and they're CFAs or smart people and they have questions about this. They'll ask you anything about this. I want to make sure you understand where the revenue comes from, where the money goes, what the strategy of the company is. And so you need to look at something when you look at a stock like Atlassian or a company you might work for or a company that you work near, or maybe you drive by the company every day and you're like, oh, maybe I should buy stock there. That's actually a bias that we have. We have this local, people are very locally biased on stocks. They think they know better. It's a behavioral finance maxim. So when we look at stocks themselves, though, look at a company and look at its trajectory, look at its earnings. Try to figure out what is it becoming more or less profitable. What are the products that they're trying to sell? And are these products better than what's out there now? Are they competing well in the marketplace? Are they taking on a bigger or less than market share? Bigger market share or less market share? Base it on fundamentals. You can just Warren Buffett these things. And if you shake it out, your thesis for a company might differ from your neighbors looking at the same numbers, but it should give you more insight as to what. So if a company says, I'm dropping 1,600 jobs because of AI, you can learn quickly. I'm like, well, actually, your revenue has been declining in these sectors and your products suck and they don't operate in ways or in mechanisms that we expect them to. Then those are the answers that you have to front and you have to discuss with them about. And it's not going to be what they tell you. It will be other things. There's this whole finance literature about examining even what investors say. So when you release, so if you're publicly traded company, you have to produce quarterly statements that are released by the Securities and Exchange Commission, the SEC. So every quarter, your CFO or other people have to get online and they have to go up to the microphone and you have to have a little thing. You have a little earnings call and you kind of go over the results with your stockholders and everybody can be there and people can ask questions and all those things. And sometimes you have an annual shareholder meeting like Berkshire Hathaway does in Nebraska, and you do other things like this that you can do. And so when you have these little discussions, you can you can learn a lot by what people say. And there's a lot of literature in finance that studies word choice, word usage, subtleties of language that might be communicated to investors and how those have resulted in differential outcomes for those trades. Take a look. It is very fascinating stuff. So how they say it and what they say it is great. But I think they're looking at the politics saying it's AI, and it could be or could not be the case. Now, if their product is just easily replicable by AI, then they have a problem or something else. So anyway, so we had a question about the Fed in this, and somebody asked, and they said, "Well, what good is it when the Fed lowers the rate to 0%? Why does the Fed have such a hold over our lives?" And the Fed we have set up in the United States at various times in our history an independent bank. It is a banker's bank. It helps regulate the economy. And it is designed to be independent in nature. And in that role, that bank is seeking, in the United States, our bank seeks a dual mandate. They seek to have maximum employment and they seek to have inflation at around 2%. They don't say negative inflation because that means deflation, which means that if you have deflation, the products are getting cheaper, companies get really wary about investing in stuff and putting stuff in the market. So that can result in greater economic malaise. You don't want to say inflation of like 7% because that's too high and that's hard for consumers to adjust to, for markets to adjust to. And everybody gets really, really annoyed, as we found out a couple years ago. So 2% is the magic number the Fed chooses. Now, when we look at, we'll never see Subway's $5 footlong again. Well, I have a Costco hot dog that I stare at every other weekend when I have the cojones to go to Costco and bay the crowds. And I say, Godspeed, hot dog, for keeping that at 150. And then you have the Fed rate, and the Fed controls basically one interest rate most fundamentally, the discount rate. That's overnight lending to big banks. So short-term lending, big banks. But if big banks get financing from the Fed, everybody gets financing from the Fed. It has a ripple effect on all those other rates in the system. So when we have inflation, right? Inflation's too high. The Fed checks their numbers. They go over their sheets of paper. They check their scrolls. I have a scroll handy just for this. And they decide They read the scrolls and they decide, and they look at them and they say, "Oh, inflation's too high. We got to do something about this. What are we going to do about this?" People. And they get together, they huddle, and they decide they're going to raise interest rates. And why do they raise interest rates? Because if they raise interest rates, it makes investing in stuff more expensive. That means people do less investing in stuff. That means factories don't get built as much. People ask for fewer loans and less money starts sloshing around the economy because inflation happens when there's too much money floating around and not enough places to put it. And so they restrict the monetary supply, they raise rates. It makes stuff expensive to borrow, but it reduces the monetary supply and it helps stabilize or reduce inflation. Now, when the economy, when President Trump says, "Oh, I want rates to be zero," and he wants rates to go down, what he's saying is he wants them to lower rates. And lower rates can stimulate inflation for sure, but they also make borrowing really, really cheap. And if you are a debt-laden nation like the United States, there's nothing you like better than cheap borrowing. So we like around the country. But it's also if you build a factory, if you build a new company, if you take out a loan to build a building or something else, you're going to have to take out these low interest rate loans. Lower rates are fuel to the economy's fire. That means, as Albert points out, cheaper money. And as Albert points out, who likes cheap money? More tech companies. So that idea that you have for a brand new, fantastic, I don't know, what is it? A new, I don't know, a new enterprise software idea where you take, a couple of, God, enterprise software is hilarious. I love the many ways that we create clever software and then poorly execute it when it's inside of a company. That to rival Salesforce, you call it, Albert's Force. And you have this great idea. Might be a terrible idea when interest rates are high. When it's 0%, investors are going, this seems like a good time to do this. And so a lot of things happen. Tech gets a lot of money, everybody gets money, sunshine, rainbows, and magical unicorns. So that's what happens when rates are zero. But the problem is it puts inflationary pressure because you're putting so much money out there. You got to put a lid on that thing. And so what happens inevitably after some period of 0% rates is we got to raise them again because we're get worried about inflation. Melanie, enterprise software built to look like Earth's computer on the Enterprise. Did you ask Atlassian about that one? I think they might be working on that. I would love a bunch of blinking lights and knobs, and also something that looks like a radar that actually does nothing. I would love that at my desk, and that is so important. Take that, Salesforce. So in this one here, and so in the Fed right now, the Fed is in a tricky, tricky spigot right now because they're trying to control two things. They're looking at a bunch of data coming out. One is that, remember, the Fed wants us to have full employment. And how are the employment numbers looking? They're not looking stellar, anybody. It is right there. It's the ninth inning. We're down, by 12 runs. And all we got to do, and it's looking like it's a little dangerous for us because right up here, we've got this. We've got these downside in private payrolls. People aren't hiring, but then at the same time, we're seeing some fuel happen. We're seeing hourly earnings continue to rise higher than the inflation rate, which is good for you, me, and everyone else. But the problem is that helps fuel inflation. You're seeing the participation rate drops. You're seeing these mixture of negative news and inflationary pressures driven by uncertainties in the global economy. And this is a combination the Fed wants to avoid. Because what this means is if you don't want a situation where you have simultaneously higher inflation and low employment, because that means they're much more powerless to enact that. That's like stagflation in that case, or I'm sorry, or economic growth or employment growth staying negative, but with the cherry on top of higher inflation. But right now, and I guess a source of hope is we still have that good GDP growth, but it is a jobless GDP growth in terms of the jobs we're generating. So this is fascinating to see how this in particular is going to pan out in the next year or so. Now, on the topic of inflation, have you on the West Coast felt a little inflationer than average, more inflationary than average? So if we go back since to the rest of the United States, inflation follows a lot of reasons. Some of it might be economic growth, some of it might be other things, some of it might be exposure to tariffs and other things too. So looking at the February data that came out from Bloomberg around the country, and you can see we're divided here regionally into areas that measure inflation. We're not necessarily looking at like really coherent economic blocks here. But you see, for much of the West, your inflation is running higher than the US average, and particularly on the West Coast and in the Midwest, you're approaching that 3% level. Lowest, interestingly, in New England and the Texas area, where you're down in the 1% level in the manageable bits. On top of that, the Fed is managing this across a diverse ecosystem that is the United States, which isn't as diverse as, say, Europe is in the European Union, but it is diverse in the sense that each of these different economies or sub-economies have different pressures on them. And that's creating kind of a differential in opinion as to where the Fed should go, which is why I believe my projection is we're going to see not a lot of Fed movement this year, like very little. And I think that that quest to be 0%, even if you bring in a new Fed chair and all that, it's going to be a tough go for them given the upward pressure on prices. They're going to want to keep rates relatively high, but they also want to keep them low enough to stimulate employment. They'll try to lower it, like one or two times they'll probably lower it, but I don't see them going further on that. And you can replay this in a year from now when it's vastly different, and I'll be like, I didn't know. So it'll be fun. But that's my best bet. So, okay, unemployment rates. Digging back into the question of our lower worker, so I had a couple of things. This is very interesting. So I had a couple of very interesting questions. One was, I'm over 60. Is there going to be jobs for me? Where are the jobs? And the other people are like, I'm under 25. Is there jobs for me? As somebody who's neither over 60 nor under 25, I'm taking both of your jobs. That's what I'm gonna do. I'm gonna take them and I'm gonna eat them. No, I'm gonna take them, I'm gonna take them. I'm going to we're going to talk about this realistically because it's a little bit more nuanced than we thought. And this is hard. This is a bit of an eye test because there are different scales on each of these numbers, and I can read them on my my computer. And if you can read them translated through the interwebs very fuzzily, you'll probably have a hard time. But let me read you the keys a little bit. So this is a graph of unemployment rates for each of these. They run from 2022 to today, till 2026. On the left-hand side, for the under 25 unemployment rate, the left axis runs from 6.5% to 11%. So we get higher unemployment, especially if you are younger. That unemployment rate has risen quite a bit since 2022, and it was 8. Now it stands at 9.3, but it is lower than where it was about a year ago, interestingly enough. The 25 to 54 unemployment rate. Yeah, yours truly, just rock and rolling in this category. The royal we. The left-hand axis runs from 2.8 to 4.2. We're at 3.9% right now. And that has been steady. That has been prone to a lot less volatility back and forth. The 55 plus unemployment rate, another good point, still lower than the 25 to 54. I would like to point out, runs from about 2.2 to 3.4, but it is also running higher at 3.3. So when you look at this data, what do you extract from this? What are the things that you look at and you're like, oh, this is interesting. So first of all, 55 plus, you're still in a pretty competitive economic zone. Your unemployment rate's rising and it's rising steadily, but it's risen by it's gone up from like 2.4 to like 3.3. And if you're looking at 25 to 54, you've gone up also similarly about 1% from like 2.9 to 3.9. But if you're a young person, you've gone up over 1% from 8 to 9.3. And if we had just pulled this 6 months earlier, you would have been over 10%. In particular, the under 25 unemployment rate is more volatile because when you go to, for instance, graduate school or something else, you remove yourself from employment. And so you're not counted as part of this. And so some of this may be people going back to school, going back to other training programs, et cetera. I mean, we're certainly seeing an uptick right now in graduate applications. Our graduate applications are up about 27% over the previous year, which bodes wonderfully for our bottom line next year. But I suspect we're seeing some of this driven by people who have become frustrated with the market, going back for graduate degrees and then getting those graduate degrees and now being frustrated that they don't have unemployment in a grad degree. But there's a lot to say, and I think there is enough to say that the under 25 employment is interesting, and it's not being affected by AI, but it does historically run higher than other places. Now, ask yourself this question, Albert's List. What is the probability of you losing your job versus the probability of leaving your job voluntarily? Anyone in a golden handcuffs type situation? where they're like, I'd like to leave, but I can't. So you've got this sort of issue here, and the mean probability of losing a job since 2013 has gone down a little bit, in fact, in aggregate. And so back to the positive notes. So if we're going back in this, the mean probability of an average worker losing their job in the United States sits around the 13% level. And that is not so different than what we've seen in the last 12 years. This is why I don't think it's all doom and gloom in AI for those reasons. It was obviously higher in 2020 when we had a bunch of layoffs in COVID. That was over 20% of workers. But in the last 12 months, ask yourself, what was the probability? So one out of every eight employees, like it has been for some time, will lose their job for their reasons, not reasons, good reasons, bad reasons, layoffs. Now, if you leave your job voluntarily, now that's interesting. Back in those ancient sunshine and happy days in 2017 when the world was green and things were nice, about a little bit more than almost actually a quarter, 23% of people in a given year would leave their job voluntarily. That's significant. Now, and that's interesting. In the last year, this has just fallen from a 20% level down to about 16. And this is interesting to see how this will go. This is the lowest actually we've seen on record. And so people are anxious about their jobs. They don't want to leave their jobs. There might be other factors involved. You might be stuck with, a really gloriously low interest rate mortgage that you got a few years ago and you don't want to move. That might be a factor. Or it might be anxiety about the market. Could I get another job? Why would I remove myself from a position where I have developed a institutional reputation to go to a place where it's going to be more volatile and it's harder to ascertain if this is the right choice for me in the future. And so when you think about this is a very important chart for Albert's list. And this comes directly from the New York Fed's survey of consumer expectations. And it's going to be interesting to see. And this is anxiety personified. If you're less anxious about your job potential, you do feel more comfortable switching. But there's a lot of anxiety out there. Feel good. You're one with this. This is the deal. Everyone will be okay. Most people will be okay. Albert will be fine. So back to the 65 and over workers, because I like this 16 over workers. I'm sorry. It was a great question, and I just don't treat this enough. So wages of workers ages 65 and older are actually catching up with those of younger workers. So historically they were undervalued. Now that value has come up. We also know that today's older workers are almost as educated as our younger workers. And young workers, though, on the right-hand side, are now getting the 1-2 punch of being hit with artificial intelligence. So if we look at workers ages 22 to 25 in the most exposed occupations, so the top 20% of occupations most exposed to artificial intelligence, Stanford's Digital Economy Lab estimates that there's a 16% decline in these jobs, which is fascinating to note. So AI is having an effect. And back to the point, I don't think this data is going to be analyzed in detail for decades to come. And there is a lag, of course, between when we publish research and things like finance, which takes us years to do. To get a paper through all the peer review process, it takes 2 or 3 years. And then, there's that question we fight among ourselves as academics, and we decide, oh, this variable is important, this isn't important, and Dr. Balderdash, I don't trust you. And so, I'm not talking to you at the conference. And then you have like everything in academia is hyper dramatic for very stupid reasons. So there are things down here, and you're just like, why can't we be friends? Negatives, I have so many. Albert, I have only frenemies in academia. Academia is one giant frenemy. If you talk to these people, they're all a bunch of just delightful geniuses who are like, I don't trust you're doing the same work as me. I don't like you. You're doing work that's different than me. I don't like you because it's different. You're doing work that cites me. Oh, you're just pandering to me. I don't like you. This is a fascinating dynamic. Sell $10 bananas in Dolores Park. Is that good? Is that a going price of a Dolores Park banana these days? Oh my God. I wish I'm gonna have to I was thinking if I came in, I gotta fly to California actually tomorrow. Is it possible for me to bring a pack of $8 bananas to underprice the Dolores Park Mafia? I'm interested in this. So get back to me. If you want to sell bananas, Reilly White, Dolores Park, 4 p.m. Mike, NB, I've been offered senior development jobs that paid $20 an hour after taxes. In San Francisco, you can spend half your hourly take home of a senior developer on one banana as a stick. But is it the best banana that you've ever had? Actually, it is gonna be great. You can buy your own bananas and sit in Dolores Park for free, Nicole says. That's great. I know. Oh, that's great. You know what? I'm very intrigued. Actually, I think I'm gonna have to check it out. When we're gonna go down there, I'll have like a trench coat, a bunch of bananas, like organic on one side, non-organic on the other, just machine made. I want, I know, just that'll be great. That's how I'm gonna get arrested. Um, that's get a good life. Well, it's vanilla hemp with the strawberry drizzle. You know, for $10, if it's banana sized and you can smoke it, it's probably a good deal. But don't take my advice. Next on this, you've got a few things here, morals and quarrels. In the US, people have a low opinion of their countrymen. So you probably saw this chart floating around the interwebs on the Twitter and the blue sky and the shenanigans and all those things. So in many countries, people see their fellow citizens as morally good. Not incidentally, in the United States, right now in the United States, fascinatingly, this chart is very interesting for us. We are the only country where a majority of people will say the majority of the country is somewhat bad. So it's great. And you look at us, you're like, who else is so untrusting as a people? And you've got Turkey and you've got Brazil and you've got Greece. I was talking to a Greek friend about this last weekend, and he's like, "Well, it's like everything. I mean, people, it's demonstrated cynicism. We have a history, we have a 2,500 year history of cynicism, and then you've got like Canada at the bottom, where Canada is so wonderfully self-righteous. 92% Canadians view their fellow Canadians, as being somewhat good or very good in moral and ethics, which is fascinating. Now, we have, of course, the United States, a healthy dose of cynicism, which is delightful. And you might be saying to yourself, I don't like anybody else, and I don't find them moral or ethical. And if we look at the summary of images we look at these things versus other people, people are pretty positive about the Pope. Stephen Colbert, pretty positive. And we think about negative, Marco Rubio, a little negative, little medium level. JD Vance, kind of negative. AOC, a little negative. Republican Party, negative. Gavin Newsom, just rocking and rolling. Apparently, despite the wit, I love his trolling. Still trolling pretty negative. And Iran, Iran's at the worst. And so I felt like at some point the government made a decision. They saw this and were like, I'm gonna bomb Iran. That's right. That's the most successful thing I can do. It's very, very fun. I know. I love British humor, Melanie. It is just delightful every time. Every time. Why am I showing you this in an economics lecture? Because so trade is based fundamentally on some level of trust, intuitively or not intuitively. We can trade with people we don't agree with, we don't like, happens all the time, we don't find moral. But it is interesting that in this country, as a nation, one of the reasons we don't get stuff done that might say improve upon it is we are very in the United States, we are uniquely, of course, bilateral. We are uniquely divided, I think, among our categories of units. And that makes it very hard when we think about things like putting forth new policies. Now, this is interesting. And so I want to kind of learn this a little bit today. I'm keeping an eye on that federal housing policy bill that's been chugging along through the Senate, and now it's up to some reasons for the House. This is interesting. And so one of the deals that you always hear about this in this lecture is I find, my personal crusade, or that's a little bit too charged a word. My personal desire is to see more affordable housing in general. Some of that that has to be handled broadly. If you look at the scale of housing that needs to happen in places where there's economic growth, you need to build more and build more substantially. And this is a little discouraging because we look at John Burns' research, and they do a lot of construction stuff. That makes it very interesting. They've got this proprietary database, and they track kind of building activity across the country. And we saw this jump up in multifamily deliveries that we saw. and single family detached, but especially things like those townhomes mixed. These things really help build supply in an area. And up to the fourth quarter of 23. But since then, it's been kind of a downward trend. We do need to build more housing, but it's just not being built because in the 10 years prior to COVID, we had very little building activity. Prices went up. Now we had a surge in building activity, but now it's falling back just at a time when I think we might need some help on this. So I had another great question in the docket, and they said there's going to be tariff refunds. Yeah, so as you know, the Supreme Court ruled that as it turns out, the tariffs are not legal that the president put forth. And so they have to issue some type of tariff refund, right? And you're like, oh, great. How's that going to look? Is it going to come to me? Am I going to get some money? No. And here's why. So legally, tariffs are paid by the importer of record. So these are usually wholesalers, manufacturers, large retailers. So any refund process will return money to those firms, not to downstream buyers. And so the Court of International Trade has already indicated that importers whose entries were subject to the invalid tariffs are entitled to refunds, likely including interest. Okay, but who gets it? So $166 billion of tariffs, 330,000 importers, 53 million individual import entries. That'll be $3 for the Kohl's importer. U.S. Customs and Border Protection is building a refund portal to process these claims, but this thing is going to take a while. And it's going to go to these importers, and it's not going to come back. And the companies who paid these tariffs aren't going to look at you and they're going to say, well, sorry about those higher prices, folks. I'm not going to give you a refund and thank you for the higher prices that you're now used to. It will hopefully, though, in a competitive market, among competitive markets, result in, if we take out the question of tariffs, result in competition being restored and companies providing lower prices because they want to sell you more stuff to beat the other competition. That's how competitive markets work. But unfortunately, there's no guarantee, and many of the markets themselves have varying levels of competitive actions. So this is the downside of tariffs in the sense. Even though they're ruled illegal, the damage is done. And which budget does that refund come from? So we're looking at these things, an interesting thing. And so ultimately, it has to be a transfer. The government, being the collector of said revenues, then has to somehow distribute those revenues. And this refund portal is going to have to distribute that downstream. And back to the budgetary question, Congressional Budget Office, the way that we've looked at the planning around tariffs, this is substantial. And we're going to have to take all that money that was collected and looked at a positive thing and send it back to the companies that are there. And this is not a guarantee, too, because the president has indicated, of course, that there's also going to be other sources where they can raise tariffs, and they'll try a few other legal loopholes to try to make that happen. It's going to be a battle. And so this is going to be interesting. But that being said, okay, so because the president said that more tariffs might be coming down the line, so other targets of tariffs coming down the line, even if they're not done the same way or done, say, through a Congress or something else, when you mention that tariffs might come down the line, and whether or not you have tariffs or not, there is actually an effect that we observe in the markets. And we see this across price increases in very specific sectors, from apparel to appliances to audio equipment to transportation commodities, laundry equipment, household furniture and supplies. Immediately, when you look at this, that you're suspecting an industry of potentially having a tariff, we're going to have to actually start enforcing that. And people get nervous, supply chains get nervous, prices go up even before the tariff actually goes online. Because like markets, like the stock price, which adjusts automatically based upon millions of people trading, prices work the same way. And it's fascinating to see this in some large, deep markets that even talking about tariffs will raise prices. So you're sitting around here going, how's the stocks market doing, Reilly? And I said, I wish it could be better. So US stocks, interestingly enough, so if you've been following the markets for a couple of decades, like me, we had some interesting. It was always a joke, right? You'd always go back and we'd say, "Oh, it's time for international stocks. This is the moment for emerging economies to finally hit up and make it happen." And we never actually saw Like we had, it was like waiting for Godot, it doesn't, and those of you, I don't want to give away the ending, but Godot doesn't really show up. But Godot, we kept waiting for the emerging market economy to come back. We had all this positive data. These companies looked really profitable and they had low prices in places like China. I remember like my students would go right in there and they'd pitch 10 years ago. They'd be like, oh, it's gonna be Alibaba. And they have all these things in it and they get really jazzed about it. And then it just wouldn't come to fruition or fruition or fruition. We'd have all these disappointing results. Now, because everything in the United States, we just rock and rolled it for like 2 decades. Now, is this the winter of our fiscal discontent, our stock discontent? If we look at so far, one of the ways we track U.S. stocks versus the rest of the world, the performance of the S&P 500, the 500 biggest U.S. companies, minus the MSCI World Index, which is everybody but the United States in percentage points. So if this number is negative, the US stock market's doing worse. If this number is positive, as it has been in most years, the US stock market is beating the world. And so right now in 2026, right after 2025, look at us. We are just cruising down disappointment cliff here. And we were just having this discussion because I'm also a trustee on one of our state pensions, our $19 billion pension. And I'm like, this is happening. And that's why we're overweighted in emerging economies because it is likely to outperform US markets, at least in the short term, which leads into a question I had that's delightful. I don't know who asked this, but I love that they asked this. They said, can you comment about the economy of Australia? And I thought, this is lovely that I have a secret Australian person coming in. And maybe they're visiting or maybe they just love Australia. Maybe they're an enthusiast. Maybe they saw Kevin Rudd speak once and it was just miraculous. So, long story short, Australia for many years, for decades, was a resource driven economy, and GDP growth typically eclipsed many other large economies, including the United States, because they were so heavily focused. They were like recession free for like 3 decades because of just the wealth of natural resources and the exports that came from them at all. They were able to continually generate and grow their economy. They've been under some doldrums as of late, like the rest. I'm another job seeker living in Australia. Chris, that is fantastic. That's what I like to see. Good. And so it's a fascinating market to watch, actually. And it is, on our neighbors across the Pacific, it is a really interesting dynamic economy. So good news about Australia, bad news about economy. First, on the right-hand side, just as an eye test, the cheap data on this, those of you who want a quick review about this, United States, we look at the numbers here. United States is a richer GDP per capita. We have a higher high end than Australia. That drives a lot of that. But debt to GDP ratio in Australia is a lot more favorable. They have only about 50% of the debt to GDP ratio compared to 122% or 100% plus in the United States. They run a deficit. We run a deficit, but as a percent of GDP, ours is greater. They have obviously greater expenditure on things, on some things, but most of their things, like for instance, government health expenditures, defense expenditures, particularly education, are lower as a percent of their budget than we do. On the bottom line, Australia's been affected by a lot of the economic concerns lately. They're also exposed to AI, all those things that we consider. Global economies are often alike, especially developed ones. But there are some things of noting. So government's trying to spend a little bit more than usual. That's outpacing GDP growth. That's interesting to watch. GDP surged higher, but inflation also jumped above target, and the Bank of Australia is going to have this interesting approach in what it does next year in response to inflationary targets. The labor market in general does remain substantially robust, and I checked out some historic data. Their unemployment's at 4.3%. It is very similar to parts of the United States in that way. They're heavily investing in business centers, data centers, and they have, of course, this high component. But I think Australia will benefit from one thing that the United States will not, and that is, well, we are aggressively trying to alienate trading partners without necessarily like a cohesive plan as to how we might fix this in the future. The Australians have been, despite having kind of a fun array of prime ministers in the last few years, and especially, I don't have like a particular opinion one way or another about some of these shenanigans, like Albanese. I mean, all these guys are fascinating. But you're looking at a country that is well positioned potentially to take advantage of some economic malaise that the United States does for itself. But the question is, with any trading partner of the United States, you have to ask yourself, if we shoot ourselves in the foot, who else feels pain? And it's anyone who might be connected to us. And so Vikram says, Australia transition out of a resource export economy? That's a really good question. As a percentage let me get the data for you because they are still very much, they still produce a ton of resources. And if we look to their current account balance and their GDP, this is interesting. So let me grab that quickly. They do such a good job. They have so many resources and gold and these things. They're approximately 13% of GDP in 2021. Resource rents, mining sector alone goes up to around 10% of GDP. So a much bigger proportion than in the United States. So it's like a version of a diversified US economy, but with a higher emphasis on natural resource exports as a percentage of its GDP production and population. And that has benefited Australia in the last year, given the high prices we've seen in commodities. So it stands to reason that it's well positioned. Of course, it's also closer to many Pacific trading partners that are growing. And I think right now we're seeing overall right now that's actually true too. A few prime ministers ago, they made huge inroads into China, and China's, sort of falling off the rails a bit with their GDP growth has affected Australia. But again, they've been like and I have to look at this. If you compare Australia to some place like Europe or somewhere else, or even the way, if you look at, say, when the former Prime Minister of New Zealand moved, she moved to Australia. You have these things here that are very attractive and that are very symbolic of the strength of its economy. I'm very bullish on their economy. They're reasonably isolated. They have still strong trading partners globally. They export a lot of stuff. I'm actually very positive about the Australian economy from everything I've read, and so that's my comment upon it. But I like this. I like that we're having this discussion about this, and I'm happy to go into more details or counter if there's any other change on this. But also, there's such malaise with the United States kind of unshouldering this global leader, which will have negative repercussions for us, but it could be advantageous to other economies that take advantage of this. But the world is changing, and it's going to be strange to see how Australia takes advantage of this because they're also tied heavily to us. And so this has been interesting. And I want to also address, before I end, a couple other questions we had. I had a great question. Let me just adjust my screen sharing a bit so I can go back to my screen so I can look at my notes, which I have to adjust my screen. I invested in one of those giant epically sized monitors that are wholly impractical, but God, I just love looking at it. And it's probably what's killing my my machine. And so I have to change my screen resolution a second. Let me just do this real quick, and I'll tell you some answers to some other questions. So I had a really interesting and insightful question about user experience. And somebody asked me, and they said, "Look, what could, so what is the trajectory for specialized roles in tech specifically? What is the trajectory for user experience researchers, UX designers, product managers? It seems AI is replacing aspects of this job." So I went and I spoke to my UX friends. Do UX people have friends? No, they have friends. They're really good. They're the most social. They're awesome people. So if you look at an old kind of user experience workflow, right? You do research, analysis, wireframes, testing, iteration, and you do like an AI augmented version of this. You're going to get an AI analysis. You're going to get some designer interpretation, lead to strategy and system design. So basically, the sense of this, and I'm following and I read a few things on this to kind of look into this more deeply about this. So, and I'm interested in your experience and user experience. Is the core insight is that, a lot of AI automates large parts, I think, of the pipeline of user experience. But thinking things like that are automated. So if it's user interviews, transcriptions, or research notes, or generating, journey maps or personas, or writing, microcopy or something, AI can do all that, right? And so then you're going to have to go in and say, well, what do humans do? And they're going to do all this other stuff. And so because AI could be supplementing workers as a tool, when productivity rises, firms might need fewer people. And that also may be why user experience positions may be harder to find, especially at intro level. But it's not drying up, but it is changing. And the role, I think, is changing. I think it's moving up the value chain. So this is good. So Chris, this is interesting. You're saying, back to the Australia question. I just read that. So Chris says the job market is flat as it was during the GFC in Australia. What's interesting, I mean, if flat is one thing, but at a four, you have a 4.3% unemployment rate in Australia. That is full employment in any economy globally, and it's like ours in that sense. It doesn't mean, and I want to qualify that compared to the global financial crisis, Australia weathered it relatively well, but you have, again, unemployment rates that are very, very good. Like that's actually something that's aspirational. If we look at kind of before the 2000 period in the world, I mean, the United States in particular, an unemployment rate of 5% was considered kind of structurally our maximum. And since that time, it has gone down. And so I think that it is still very resilient. And I'm actually gonna let me see if I can link you to uh, this is a recent publication that kind of looks at a snapshot over time of Australian post-pandemic resilience. But I don't know, it was published in 26, but this is the kind of academic stuff I like to read, but this might or may not be useful for you in Australia, but it's kind of a fun little article that kind of unpacks why it is that way. But let me see if I can do this. Really fun detail for you, Chris, too, on that. And so Melanie says user experience has always been regarded as kind of a nice to have thing. AI will be seen as good enough. So you think, and that's an interesting discussion. So do you think, Melanie, that AI then will allow people to perform enough perfunctory user experience roles to then actually not contract out and use that? That's fascinating. That is the tangible fear of this. I see a lot of hope, but I see a lot of existential crises. I got deep into the UX side of things and I was trying to be like, well, what's going on here, guys? And it is, gosh, they are. And I realize, are all the people who are negative about the economy, are they all user experience people? Because I get down to all these articles and I'm like, it's the death to it. But I think, I still think like in many cases, I think your ability to communicate something that is fundamental to design is always going to be needed. But I guess the point is, we will see. The proof will be in the pudding. And maybe if we're back to the question about whether our jobs ourselves are existentially BS or not, that is going to be a fantastic fundamental question for us to address in the coming years. So fascinating. This is fascinating stuff. Oh, other questions. We had positive indicators. We got that. I said, do you see this turning around as long as Trump is in office? And how can individuals overcome this? So this is tricky. And so Trump is a completely different economic paradigm as a human being. And chaos is costly. And this is not helping us, and it's doing a lot of other things that work well. And I'm interested to see how this happens. But here's my fear, and why I kind of talked about my fear is much more macro. And we looked at the benefit of U.S. stocks being so globally successful in the last 20 years. We attracted so much global investment because we were a source of safety. We were generating significant returns. We had places where people could park their money in things like, expansive private equity regimes in places that just in the deepest capital markets in the world, which represent, by the way, 60% of the global capitalization is in the U.S. equity market, which is the only place where the U.S. is that dominant in that way. And it's extraordinary. So if you're an investor, you're parking money in the United States. And the fear is, will the president create an environment that is so oddly hostile that foreign investors are turned off and are looking towards developing nations? And our big discussion among the pension, elite was whether or not this is a temporary or long-term thing, meaning that are people going to now shift their investment schemes like they did for the last 20 years, where it was very US focused? Are they now going to be like, nope, we're going to shift it elsewhere? And when they shift it elsewhere, those prophecies can be self-fulfilling. Investment begets other investment. And so when you actually position the US as being something of a more dangerous place to invest, or something where where the returns are disappointing, people start looking around. They look in their backyards, they look in other nations, they look in Australia, and they find places and say, look, maybe here's where we should invest for the future. And I think this is tricky because the engine of the United States has been innovation and economic growth in the Bay Area, in tech, in cycles. And how can we hold on to this? And can a single president shift that? It seems unlikely, but it is a fear that I have. Now, Karina, you say, is there any insights about the state of jobs in architecture? Oh my gosh, that's great. Let me see if I can dig up some data on this. I'm gonna hold on, let me blow this off. I haven't had an architecture question in a long time. Let me just blow off this old data tome, and I'm going to dig into this here. And so this is funny. You look up things like outlooks. The Bureau of Labor Statistics does all these kind of. They have a bunch of economists crunching these numbers, and they thought, in 2023 that it was going to grow at like 4% or so on average, and I think per year. But I think right now, like anything else, what's thrown all of those projections out of the water um, has been AI. And I have to look into this a little bit more because I'm thinking of something I read, and I have actually meeting with one of our architecture, our School of Architecture leaders recently, and I'll have to ask them for some points about this. Are you sensing, I guess? And so architecture being a like all firms, you have architects themselves, but also all the supporting infrastructure, all the designers, all the drafters, all people with different jobs and different experience in this. I am curious about how you're seeing the market right now, because there is, for instance, architecture demand will be driven partially by macro information. So partially by are people building and designing things? Is there investment to come? If we lower interest rates for instance, that means people will start building factories, houses, firms, other things. And that stands to reason that architects will be behind all of them in some capacity. Any refurb, any renovation. I know that it's been a up and down sort of market, but I think it's going to be tied to macro factors. But I don't know specifically how AI is going to be changing this. And so and so all the data I have, this old data is completely whack now because of the AI portion of this. And so there's kind of this cyclical slowdown, but I think, yeah, high interest rates, people are saying the same things. But I would say that follow where the money is in terms of, so I guess my specialty, my special might be one of the things, Antonia, one of the things you could look at would be uh, uh, I'm curious if you're finding different specialties of architecture doing better than others. The last couple of years, we've seen an explosion of healthcare jobs. We've seen an explosion of, despite this month, and a growth in capital and healthcare facilities as well as capital and data centers. Imagine, I'm a data center architect. And so I'm curious, I suppose, by industry, if that was a specialization that you might follow, or those companies engaged in those firms should be doing better. Poonam said, what are your feelings on how the current ongoing war between US, Israel, Iran, and the Middle East will affect the state of the current job market in the Bay Area? So as you know, we're all connected, and these things are strange things. And like Albert, I was explaining, I was in the Middle East too very recently, in a few different countries over there, and so this is it's a really tragic time for everyone, just everybody, and anybody who's involved. No one wants I'm always on the side of peace. And I think that there is so how would that affect us? So the first thing is let's talk about this realistically. So how does something in the Middle East affect the United States? Now we don't have tons of vested interest in Iran. In the last few years, we've certainly severed a lot of our trading relationships or nascent trading relationships we might have had. In the spirit of this, though, the biggest effect, of course, is on volatility in energy markets. And so we saw the oil price. So there's two ways we look at oil prices. One is called West Texas Intermediate. That's kind of the price of oil in Cushing, Oklahoma. And then there's something called Brent, which is international oil prices. And they both kind of move in roughly the same direction most of the time. And oil prices, of course, you see at the pump. And so let's break that down. And so let me go back, let's say about a month ago, actually a little bit less than a month ago, 3 weeks ago, oil was trading at about $65 a barrel. When the war started, when we started the war, we shot to $95 a barrel, and now we're cruising at about $94 a barrel right now in oil prices, and that's why gas is expensive. Now, gas takes a few days to run through the system. Oil is the biggest single component to gas prices, but there's production costs, refining costs, all of those things that are tied into this. And so oil being driving this factor, driving this uncertainty, has a huge effect on companies everywhere from distribution to extra costs that get tacked on to you shipping products anywhere for any reason. The stuff that you buy that you can't make locally will have a higher price attached to it. It puts a lot of upward pressure on inflation in that market. One of the things that's benefited us over the last few years has been a declining price in oil, relatively speaking. Like in 2024, it was on $80 a barrel. In 2025, it was doing this kind of thing. And we broke down what caused inflation. It was always a negative effect on our overall inflation. So it put us in a stronger position. Now with oil prices shooting up again, this is uncertainty. And this causes price increases all the way down the line. And it's driving up, as Michael actually says here, price of oil. Great for U.S. companies, well, producing oil. It is great uniquely for the state of New Mexico, but if you like drive a car, for instance, just with the oil price increase in the last week, an average consumer who drives about 26 mile per hour, 26 mile per gallon vehicle, drives 12,000 miles a year. That's an extra 250, $300 a year that you'll be paying for this. And that's significant. Nicole says, I heard Iran and laden ships in the Hormuz Strait are about 20% of total supply. That's right. I was actually interviewed twice about this topic this week, and that is the number, that is the best number I could find as well. Vikram, does the deficit mean anything anymore? There we go. I want some Vikram. I'm glad you're here today. And I'm glad you brought the cynicism, the nihilism, the ennui. You've been reading some Camus. We're just gonna smoke clove cigarettes and put them out while sitting in a cafe. Does anything mean anything we're gonna say? Everything is absurd. And I just want to say that this is true. So the deficit does mean something, but it means something in different ways. So there's the deficit. So brief, quick on this. So deficit is when we spend more money than we take in a given year. Collectively, deficits add up to what's called the national debt. The national debt we're going to have to pay at some point. And we're increasing the national debt. And the higher the national debt gets, the more risky our economy is perceived to be. But the United States is special. Unlike a country like Greece a few years back when they had the Greek financial crisis, because of something called the Bretton Woods Agreement in 1944, which priced commodities in US dollars, the US has been the reserve currency around the world. And so we get a lot of slack when it comes to the amount of debt that we can take on. But we do ultimately have to figure out a way to increase the revenues the government makes or spend less money. And there's not a good answer to that. We're just playing a generational game. Which generation is going to pay for it and when? So, Vikram, it does matter, but we don't know who it's going to matter the most for. And it's not going to cause any delay next year. It's not going to cause a collapse of our economy in 5 years. But it will affect us down the line eventually. And we will ultimately either have to aggregately replace our economic system or somehow, well, best case scenario is we get ahead of the national debt. We got to grow faster than our debt grows. So if we can increase GDP faster than our debt is increasing, then that gradually puts us in better fiscal shape over the long run. So make it happen. But I don't know how to do it because we're an aging society and demographics don't support it. We cut off our stream of young working immigrants who are hard workers. And so now we're getting older. And so we don't have a solution to this yet. So I'm not very positive about I'm looking ahead to like 20 or 30 years and it gets real murky, Vikram, and I'm very worried about it. Nicole says, what? I wonder if e-bikes will go up in price. I know. So go buy, you're going to sell them in Dolores Park too? This is great. Albert says, oh yeah. Oh, thanks, Albert. Yeah, are you quoting my own articles in local news? Albert, don't do that here. The kids don't want to read this. Poonam says, thank you for your insights. Personal feeling that inflation is going to hit all Americans harder the next 3 to 6 months due to global uncertainty. So the deal is here, and thank you for pointing that out so clearly, Poonam, that I think what's going to happen is if oil prices remain elevated over time, this is absolutely an inflation mover. It changes the whole variables. Companies have to pay trucks and distribution prices rise, and that hits consumers. And it's best, and that's why that an extended period of high prices is going to be bad. High oil prices it might be good for oil companies. It's good. Like I live in New Mexico. We are the second largest oil producing state. And certainly for our budget coffers, it bodes well for us. But it also causes, in the long run, some severe consequences. And I think for us in particular, we are we're still heavily exposed to oil. We don't have nearly enough electric vehicles to offset that. And the input cost for that will create inflationary pressure that the Fed will have a hard time fighting off and may even result in the Fed making fewer moves to lower the rate. So that's the key. Oh, Albert's like, if you like Social Security, Medicare, That is a question. What's going to happen to Social Security and Medicare? Going to war with Iran. Oh, you had a lot of things. Did you have that on your bingo card this year? I didn't know. We should have made geopolitical predictions for the following year and then compared them. I don't, I didn't
Well, we
know.
still have 9 months, so
Yeah,
you know,
yeah, maybe.
is
What
China
else?
gonna take Taiwan?
What else can?
Is
Yes,
Trump gonna take Cuba? Like,
yeah. Let's put Cuba on the table too. Let's just really just make
right? Will
let's
Trump's
just
invasion of
yeah, man.
Cuba
Oh,
significantly
yeah.
crater the prices of Cuban cigars at the airport?
I think that's
Right?
true. I think anytime you're smuggling goods that you don't have, Cuban prices, Cuban cigars. If you're a Cuban cigar investor, just keep an eye out. I think that's going to be a really interesting
I think
take.
Cuban cigars investors are about to get rug pulled, right? That would be
It
the
is
right way to think
this kind
about
of
it.
old school imperialism in a modern economy. I don't know how this pans out. So
Yeah.
I'm very interested in how this
And I
develops.
mean, like, right, like we were also expected to see a cryptocurrency renaissance
Oh
underneath,
yeah.
and that has yet to materialize. Oh, he's pocketed all the gains, but if you bought Bitcoin at 120, you're down what, 50%, right? So,
You know, I wrote a paper about this just actually a couple
yeah.
weeks ago. And I
Okay.
submitted it to a conference and it got in, which was surprising to me because I wrote it. I was like, I had
Hmm.
this weekend idea and I wanted to do just this, Albert. I was testing meme coins. And
Yeah.
so I developed a little metric called meme coin intensity. We're working on that now. But to that point, like you can actually, and we're trying to basically call it as you see it. We're trying to devise
Yeah.
in finance, we're trying to call these crypto areas and call it but it's still a market where you have literally billions upon billions of dollars still invested in it. So while it's not a
Yeah.
renaissance, it is still taking up $2.44 trillion of global money and putting it, according to Coin Market Cap, and putting it into stuff. And
And speaking
so
of
it's not going
betting,
away. It's
And
here.
speaking of betting, I know I haven't gotten your opinion on this, but as an economist, what is your opinion on all the different like betting sites out there, like the Kalshis and the predict
Hmm.
markets and all of those
So
things?
so okay. So as an economist or as a Riley or as both. So there's two
Your
things. So
professional
I
opinion
am
and your personal opinion, yes.
all right. So
Which
I'll
could
tell
be the
you.
same.
Which could be now it's in this case it's going to be they're going to differ a little bit and I'll explain why.
Yeah.
And so one hand, so I find from a information standpoint, prediction markets are fascinating, right? Because
Yeah.
they imply like the stock market themselves, when people trade on information and they decide what will be true in the future, the market is more right than wrong a lot. And prediction markets allow people to trade on anything from sports to events to who's going to win the Golden Globes. Now, here's the downside of this. So markets themselves, though, in the sense that we operate public markets in the United States, have to fundamentally use regulation in some way. Like I know this just shouldn't be rocket science sort of things. Like I know this is not, irrational exuberance per se, but I'm saying that like even when I talk to bankers, even when I talk to other people, I was a banker myself, regulation is helpful because it allows transparency, it preserves free information flowing and prevents or at least tries to inhibit negative behaviors through consequences. Now, sports betting and other rising. We've seen just a drastic increase in sports betting. And like anything else in the house, right? So if I have, I'm, if I'm tempted by the question of gambling, the presence of an ability to gamble will make me gamble more. And so there's this other side of this economy, which makes me sound very puritanistic, which is like, unregulated gambling does create more opportunities for people who have an opportunity to abuse that, to abuse it. But that's also human behavior. We always get tempted by if something is here versus whether something is merely hypothetical in our heads. And we all carry around devices by which we can engage in this. And so the problem is when you have such a vast expansion of very, very tenuously regulated markets, it is it produces a lot of negative externalities and it produces habits, it produces strange things. You guys are too young to remember, Pete Rose and the gambling controversy that he got into in sports betting. But the point is these things can start affecting reality, and people will look at betting and being like, okay, this is an outcome that has a 10% chance of happening. What if I play the game? and I act unethically to ensure that it happens and I make a cash value. And then therefore like nuanced things, therefore silly things that are even outside of sports. But it affects a lot of things. And it's weird to say gambling should be is the stock market gambling? The stock market is information and it's trading on that information. We don't know, there's uncertainty in it. And unlike going to a casino, the house always wins. Prediction markets kind of they're the same thing, but without regulation that enforces market rules, markets wouldn't work. And without regulation that effectively engages sports betting, it creates more harm than good.
So at the end of
So
the day, when
I
you
love the data, but I hate
right.
the action, I guess, if that makes sense.
Mm-hmm. So at
What do
the
you
end of the
think,
day, then
Albert?
when you think about it, uh, when you think about the word free market, right? Because there's always a lot
Yeah.
of argument around like what a free market
Mm,
constitutes and whether we should have regulations or things that allow for dead weight loss or Pigouvian, type situations. Can we ever
mm.
get to a point where we have a truly, truly, truly free market? Because I mean, I
Yeah.
know that if we were to do that, then some industries here in
Oh
the
yeah.
United States would collapse overnight, right?
Yeah, this is my like this is my thought exercise. This is my like going up
Yeah.
to Eureka and sitting in a circle moment. I'm like, class, imagine as soon as information became known that it was reflected in the stock market and we went, ooh, and we kind of sit around the fire and we have these discussions about it. And so we have this thing, we have this has been discredited since then. But we have, a hypothesis in finance, which deals with the level of information the information that's shared in an economy called strong form or weak form market hypothesis. In a strong form market, Albert, even the idea. So imagine I'm a CEO and I conceptualize, I'm like, today I'm wake up and I'm going to quit. And I'm a popular CEO. As soon as I think that in a strong form market, it's reflected in the stock price because people are that good. And so we have what's called kind of a weak form market. It's reflective of the information that's available to us, but it's always incomplete. There's always more information available. We've gotten better at that information over time. Back in the 1940s, the first mutual fund that was established was actually, it was able to achieve better than average returns by setting up shop right across the street, not in New York, but from where the SEC was in Washington, D.C. And they'd send their little interns over. They'd copy the statements as soon as they came out, and they were the information leaders. And it was faster than it could be transmitted over wire to New York in that time. And so they had an advantage and they made money that way. And that's what Jones and Company did in that initial thing. And so nowadays, though, with the internet and everything else, it's hard to have these informational advantages. There's companies, for instance, if you look at I got a book called The Atlas of Finance, I think, over break because that was fun. I love atlases and I love finance, so an Atlas of Finance. And it talks about it has this great graphic that shows the connections between Chicago and New York. So Chicago's a big commodity trading area, right? And so people have all these wires strung across that 1,000 miles between Chicago and New York, and they compete for speed, which is closest to light speed to offer the closest information advantage. And so Albert, to answer your question, markets are never fully perfect, but they don't break down because of information sharing. They break down because we segment and we tend when we're unregulated, we tend towards oligopolistic nature. So we can never have infinite buyers and sellers. We're always going to break, we're always going to consolidate, and then we'll have oligopolies, which are less efficient. And some markets they're okay, but that's
Hmm.
the hard part. And then they tend towards monopolies, and so you got to break those apart. And so markets have to be managed, but they also have to be free. And so that's the paradox
The
of
paradox
finance.
indeed. The paradox indeed. So,
Yeah,
final thoughts as we conclude for today. Lots of job seekers here in the audience tonight. I think one thing to think about is so as we go to our next webinar, which will be April 14th, a month from now, a lot of things will probably change. But just knowing with
who
that,
knows?
what I know, right?
Can
What
we do it? Can we
tips?
do it from Cuba next month? What do you think?
Oh, on
That's terrible.
location from Cuba.
I'm not
Well,
advocating this policy, by the way. Please understand. I know sarcasm can be hard to understand through the internet, but let me just say,
we're
yeah, thanks.
gonna just we're gonna clip the video and just say, can we do this live from Cuba and just end it there. Um, no, but what advice do you have for job seekers as you look forward today and going into the next month, with all of the things that are going on and all the new conditions that have now been introduced into this geopolitical soup and economic soup.
So, first deal is here's the deal. In our lives and everything we look at, the economy goes through cycles. We have a small lens. We only see a piece of this. And
Yeah.
we're happen to be living through a moment where there's several big forces that are hitting the market right now. You've got interest rates, you've got geopolitical instability, you've got rapid technological change. This makes it uncertain. I want to validate your feelings of uncertainty and validate your feelings of worry. But remember, labor markets never move always in a straight line. Periods of disruption are followed by periods of adaptation. And the key is, like labor markets as a whole, how are you going to adapt in the next few years? And so, adaptability, number one, relationships, number two, patience and persistence, number three. I know this is a tricky situation. Every day I talk to a student who's like, I got to find a job. The interns aren't hiring, all these things. And then I hear enough from another student later who's like, I knocked on 100 doors and somebody finally answered. And so the map is changing. There's going to be new industries, new roles, and new opportunities. Stay
Mm.
aware of what those are, and you will be well positioned for the future. And don't lose hope. Even when darkness comes, there's always
I love
dawn. The
that.
sun yet shines.
And
Indeed.
I think that actually leads into my other question, which is, uh, you mentioned that the economy always moves in cycles.
Yes.
And you can point to, I think, right, boom and busts and the reasons for why you have these boom and busts. And right now, I think we're in an AI boom that correlates with some kind of employment bust. I don't know. And right, I mean, right, we've had the recent news is that Oracle wanted to lay off 20 to 30,000 people because they had over expansion production capacity, which is a U.S. history AP term, when it came to their when it came to their investment in data centers with OpenAI and the lack of ROI they've seen on those projects. And so, um, when this party crashes, and I have no idea when it will crash because I think the members of this party are thinking like how long are trying to make it last forever. What's that going to look like? And
Mhm.
because I think, with everything in technology, things always tend to come and they tend to stay in some way or another, but they never truly fully disappear. And AI is going to have this disappearing act. What are your predictions for that?
Mm. So this is a good question. So we talk
Because
about AI as a boom bust, which I
because
like
my
your
caveat to
phrasing.
that, I should say,
Yeah, yeah,
sorry,
yeah,
is
yeah,
that
yeah. Take it away.
I've also heard the theory, right, that maybe we're in the last like ever bust and we'll never go back into any type of boom because AI will have taken so many jobs that no one will have anything to do at this juncture. And then it'll just be a perpetual like economic scarcity where
Mm.
jobs are tough to find, and that's just what it is for the future because people would rather work with agents or AI LLMs than
Yeah.
work with people because people are such a large expense and a large burden to the corporation. So
Good.
that's the second half of it.
So I like this. I like this. All right, boom and bust, but let's talk about the bust. So,
Yes.
okay, so we look at things in innovation. So I'm this magic 8 ball stat, at least.
You are a
Uh,
magic eight ball, yes.
no, I'm like at least I'm like a 4 ball at best. One of those. Anyway, anyway. So what we
And
got
I
here?
think maybe other people are thinking about
Uh,
this. I don't know. Put it in the
yeah.
webinar chat if you're thinking about it
So
like this too. Maybe I'm the
okay.
only one.
So let's say the first thing is you got to know where you are in that cycle first, right? And so this is the first part. Let's take it slow. So what do we know
Yeah.
about boom and bust cycles? I'm gonna dig deep into I'm actually in the finance and innovation department, which I have been also elected chair of next year, which is great.
Very
Among
nice.
other things, we're gonna see what's gonna happen. But there's a few things we look at. So number one, boom. What does boom look like? You have a lot of investment and a lot of hype. Then there's a crash. That's when speculative firms disappear.
But will
But the
hype
firms that had a lot
involve
of promise.
people? I mean, will
Right.
investment boom involve people at that juncture?
Hold on. I know are we just talking about
Congrats,
Chairman White,
Chairman
right?
White.
Like, I know it's always going to be, we're just going to just rock and roll this and just, oh, we have so many potentials. We're going to build our entrepreneurship concentration. Anyway,
Yeah.
so crashes happen when speculative firms disappear.
Yes.
Consolidation, right? Stronger companies survive, they figure out what's valuable, and finally reach maturity where the technology itself becomes
And
infrastructure.
that today is OpenAI versus Google Gemini versus
All that
Anthropic
stuff.
Claude,
Well,
right?
what's it going to be? And so right now
Yeah.
we're definitely so we're at this cycle where investments pouring in. It's a boom period for AI in terms of investment, which is how we look at this.
Yeah.
Now, okay. So you've got this. and this is like this is sort of a chicken egg question. So where you are in the cycle, the first thing you got to look for is does investment start pulling back, or does the stock market crash, or which happens before which one, right? And so
Mm.
the earliest signal, you might see a slowdown in venture capital and corporate investment in AI. And you'd see AI startup funding drop, maybe consolidation of smaller firms, off the record a bit.
And I don't feel
Layoffs
like
at
that's happened yet, right?
But you might also see layoffs at companies that say built products without strong revenue attached to them and then blamed it on AI. And then you've got
Hmm.
a stock market correction that often might happen. And so
Yeah.
highly valued firms, those built on expectations rather than profits that have a lot of built-in promise, start to fall back, right? And then it might include big stocks falling quickly. It might be AI infrastructure companies starting losing market value, and investors start rotating to more traditional sectors. But that's hard to follow because we're kind of doing that now because the economy is kind of iffy. And then you've got data center like oversupply. So we have all this investment and we have empty server farms, falling GPU prices, cloud computing price wars, and it starts looking like the telecom crash of 2020. And
Hmm.
then you're going to have this little period where there might be hype between the gap and the productivity gains, but I don't see that yet. And I think bottom line is it won't look like AI suddenly goes away, technology disappears, and mass technological unemployment happens overnight. It might look like sort of the dot-com crash. And those of you might have memories of that era in the Bay Area of those distinguishing factors. If you're a pets.com, former
Webvan.com.
IT
Yes.
web developer, that kind of
Yeah.
thing. Those companies that were really big and really promising. The first
And
really
some of these
really
some of
clicked.
these companies were
Yeah.
ahead of their time
Yeah.
because Webvan was the whole idea of using the internet to order your groceries and then bring it to you, and then 15 years later you get Instacart,
Ah,
right? So like
magical.
and so if we're looking at patterns there, what's the pattern? Right? Like
Yeah.
was it the infrastructure that wasn't
Right.
there and now that it's there, the idea can flourish? And I
It's
mean, I think Michael is
true.
also right in the sense that if
That's
we're looking
true.
for AI dominoes to fall,
Yeah.
Oracle will be the first one because as he says, Oracle heavily investing money it doesn't have into AI in hopes theirs will take off while trying to buy CNN, HBO, and half the media conglomerates
It's
that exist out there.
oh
Like
oh Larry, what's he gonna do next? Larry Ellison.
all
Goodness
to all to
gracious.
buy his fifth yacht and divorce his sixth wife, like at the
That's
age
right.
of 83.
How many wives did he have? Yeah, he does have six. You're right. Wow, that's
Yeah.
impressive.
And,
That's
and
good.
and his sixth wife being half his age.
Oh God.
I
But
worked at
still.
Oracle for 3 years. My claim to fame with Larry is he once drove by me in one of his Lamborghinis from
Oh,
his
did he not at you? Did he give you did he give you a salute?
nah, he was probably captured in thought, so
He's
no.
like, he's a third this age. Oh my God. What do you have in
So
common with these people? I mean, how do you
I know.
talk to these
I
things?
don't think
Anyway,
he does.
I don't
Yeah.
know. I don't think he cares. I feel like they don't have a lot of discussions. Maybe he's like, what do I do with this? And she's like, oh, yeah, yeah.
It's
I'll put a
best
lot of
friends
money
with
in it.
Larry Ellis. Yeah, oh, that would be funny. Yeah. Yeah,
Albert
he
is
he called me the other day and said, you can handle the
yeah.
prime time block for CNN. I'll take
Great.
everything else.
And
Um,
you went, Albert's list going mainstream. That's what we have to do. Turn this into a international media conglomerate. That's what we have
oh
to do.
gosh. Yeah,
So
we'll have Caitlin Collins leading into our monthly economics webinars. Yes.
don't go, don't go on his plane though. That's right, as Christopher points out.
Um,
Uh, but
so
no, that's
so
right.
okay, it's those
Yeah.
patterns, right? It's
So there's
it's
patterns, but
like
you're right. But you're right. So the infrastructure is going to build out other uses, right? Nobody knew, for instance, in the mid 90s, Amazon would be Amazon, Google would be Google. We knew that there were companies with promising ideas. And so we're going
yes.
to see this shakedown
Because
of
the
the
ultimate
companies that are
question
able to make.
is
Yeah,
we
yeah,
have
yeah.
been seeing a steady decline in job openings since 2022. The
Right.
2006 Great Recession took longer to materialize in itself, right? The 2000 dot-com bust took a while to implode. And then the, I think,
Hmm.
1992 defense recession, sequestration,
Yes.
I think is what it was called, also came pretty quickly and left pretty quickly. And so my other question is, number one, why is this taking so long to happen? And number two, if it's taking so long to happen, are we misinterpreting what's actually happening? And is
Mm.
something else happening?
No, you
Because
can't time these things.
yeah,
Yeah.
because in your world, right, everything is obvious looking backwards, but nothing is evident looking forwards,
Mm.
right?
So
Because
that's well said. That's
leading
wise.
indicators
Yeah.
versus lagging
2020,
indicators.
right? And so this catches us all the time because we know history repeats itself. We know it
Yeah.
echoes, right? Even if it doesn't repeat, it echoes.
Yeah.
And so we're looking for all the same variables. But booms and busts have a lot of things in common. They have a lot of exuberance around investment, and they all
We
have a
see that
cool down.
now. Yes,
And
exuberance
and
very
and we
much
and they always
exists.
have a cool down period. And this cool down period can be a bust. It can be it's hard to disinflate a bubble quickly, but we've seen it a couple times and it can happen. So here's what I would look for. And so back to your line on this
Yeah.
is you're going to look for the warning signs in the market, and it might not even be AI generated that causes us to rethink this. It could be a massive shift in expectations of consumer and investors that AI won't pan out as it would be. And then you'd see a lot of funds echo in mass, private equity et al., deciding to exit, go somewhere else with that money. But the question, here's the hard part, is where else would they go? And Albert, what's keeping a lot of things running right now is when people look and says, here's economics and productivity. You want to put your money somewhere that will have a return on the investment 5 years, 10 years down the line. And we
Hmm.
got AI in column A, but we don't necessarily have a column B. And that's interesting. So what I
Yeah.
think might happen is, and so because there's a lack of other alternatives, people I think are content to toss money down this way.
Has there
Down this,
ever been an
yeah.
economic situation or type of thing
Oh,
where there is no column B?
this is interesting. There's always, I'll put it this way. I'm being a little hyperbolic. There's always going to be I can invest in, whatever my local materials firm is, down here
Yeah.
or an array. But there's a lot of things that were hot buys a couple years ago that just they don't appeal. The government's changing regulatory standards, other things. And it's not like you can just rock and roll and start a new coal mine today. And that's not desirable for a
And
bunch of
because
reasons.
the other thing is that like it's always
Yeah.
been you could invest in like you could invest in coal or you could invest in agricultural equipment, right? Because the two of them don't have any parallel or are parallel to each other and are separate. But if you look at, say, for example, AI, you can't necessarily say AI or cybersecurity or blockchain because all three of those are very relevant right now. It's
Yeah.
become AI and cybersecurity because you can use AI within cybersecurity, or you can use AI and blockchain because you can use AI and the blockchain to maybe figure out who's on the blockchain and all of that stuff. And I don't know what's like separate
Yeah.
of it because
Yeah.
AI seems to be
Yeah.
embedded into everything.
Yeah. Blockchain. That's what did all the blockchain money go into AI? That's the question
Probably.
I'm trying to figure
Yeah.
out. So this is right though. So you don't know the hard part is look for those exits. Look for disappointing earnings. Look for those
Yeah.
things. Look for companies investing in this. And right
And
now,
Oracle
so
beat earnings
far,
the other day too, so we're still
they
another
beat
quarter
earnings.
from the
And
bubble.
and so has a bunch of companies this
Yeah.
quarter. And so and
Or
so
they could
that
just be
right.
putting potential earnings as earnings and then, kicking the can down the road.
We're
But
all about
eventually, a lie incurs a debt to the truth. So we will see.
Oh, so wise, Albert. That's good. A lie incurs the debt to the truth. So anyway, but this
That's
is
from the
absolutely something like,
HBO docuseries Chernobyl from 2019. I love
oh,
using that
excellent.
term.
I
Yeah.
love that. I love that series actually. I love it.
Yeah.
I have the soundtrack on my thing, which is
Oh
kind of
yeah.
ominous. I'm like, let's put on some Chernobyl soundtrack. Really when I drive my son to school in the morning, it's
Yeah.
nice. Let's listen. Let's really put you in a good mood.
All right. We are 100
So
minutes into this. So
I
final
know it's
thoughts,
been
and then I will shut it down and we'll
rock
go
and
from
roll.
there.
I love it. So here's the thing. Keep an eye
Yes.
open on all things. Try to know all things. And if you've got a sense that the market is turned, remember that even in downsides, there's always opportunities in the market. Even in a recession, somebody's going to want to buy a banana in Dolores Park. So just keep that in mind
Inelastic
as you
good. That's a
approach this.
banana.
It's an elastic good, and it might have to be
Inelastic
less
good.
than 10.
It's an
Yeah,
inelastic good. It provides magnesium and healthy nutrients that you need to survive every day. Yeah.
bananas. Have a banana meetup for Albert's list. Let's just do this. And I'm really interested in what this $10 banana is going to provide. This is going to be. You guys are the hype people. I've
Somebody
always
send
believed that.
Dr. White the San Francisco Standard article, but yes.
Yeah,
Um,
mail me the standard article. I'll get this. This will be good on those bananas.
yeah.
Thank you guys. Have a wonderful night, and
Thank
it's
you
a
guys. Yep.
delight
Have
as
a
always.
wonderful night. I'll see you next month. We'll see you next month
Connect.
for this webinar. Send in your questions and let's discover what the truth looks like. See you all soon. Bye.
Okay, bye guys.